Yes,
Assalamu alaikum.
Wa alaikum assalam wa rahmatullahi
I'm not able to share my screen.
Yes, are you not able or you are able?
The system, I don't know, it's not allowed me to share my screen.
Hold on, admin will give you permission. Yes, are you still trying to share your screen?
Yes. Okay. Thank you for this opportunity. I will go quickly, we run out of time. I'm Nassourou Aminou. I'm in charge for FCI in Africa. So I am here with my colleague, Mr. Yüce, who will have the opportunity to introduce Islamic finance. So just to go quickly who we are, FCI is an international organization for factoring. So we have around 400 members. We are a non-profit organization. Our aim to put together all the factoring companies around the world to work together. And then in Africa we have around 40 members. So we develop a factory. I will leave my colleague later to do an introduction, and we are running out of time. So you say if you want to start, maybe, probably.
Thank you, Nassourou. I cannot share my screen.
Mr. Aminou, just to highlight that you are having between 5 and 10 minutes. If you can still share the same for both of you, that would be much appreciated.
You say go ahead.
Yes. Okay. Good afternoon, ladies and gentlemen. I'm here to introduce to you a new Islamic finance product. It is Islamic International Factoring. After 18 years of my article about parallelism between factoring and Islamic financial rules, it's a pleasure for me to see that this has now been confirmed internationally by some Islamic financial institutions and FCI. To be able to see the similarities, we need to remember the history of factoring. To be able to see these similarities, we need to remember the history of factoring. Okay, therefore, I'll start with the brief history of factoring. Here, when we see factors in old times, factors were always the middleman in trade. So, when we go back to 18th century before Christ, we see Tamkarum in Mesopotamia. Tamkarum receives merchandise in consignment. They are merchants. Travels with the merchandise, sells it, collects bill of exchange, of course in the form of a tablet in clay, in the name of the principal merchant, and may purchase the bill from the merchant. So they don't wait until the end of the time on the due date. They pay to the merchant, principal merchant, earlier. And when we go back to Roman Empire, a factor was a key figure in the economy of the Roman Empire. Wealthy senators and nobles entrusted the management of their property and their agricultural products, corn, wool, oil, to agents who received a commission for their services. The agent was often called a factor. Sometimes he would be responsible for finding buyers for the products of the large estates, which often entailed making long sea voyages. In such cases, he might pay the nobleman in advance. The Phoenicians and other mercantile people also adopted such methods of trading. By the beginning of the 14th century, the commission agent form of factoring was widely conducted in northern Italy, where the commission agent sold on credit. He probably also took the credit risk. Later we see factors in England, still as middlemen in the trade of various products, wool, cloth, coal, corn, for example. With the development of overseas trade, we see factors as agents of English merchants, and finally as the commission merchants in the United States until early 1900s. Old factors worked like this. Principal merchant consigned the goods to the factor. The factor sold the goods to the buyer that it has found, and the sale is on account. The factor optionally could make a prepayment to the principal merchant even before it sells the goods. And after having received the payment from the buyer, factor paid the remaining balance to the principal merchant. This is basically very similar to Islamic murabba. After the times of Great Depression in 1929, factors in the United States started to deal with receivables instead of goods, similar to bayad-dain, that is sometimes prohibited in Islamic finance. Now, the conventional factors buy the receivables and make early payments, like in the credit card transactions. I don't think that I have to take your time repeating the basis and principles of Islamic finance here, but I want to tell about murabba-based Islamic factoring. The seller here is the party who wants to get financed. Because in murabba, generally the buyer is financed. After the seller gets the order from the buyer, the seller applies to the IFI, Islamic Financial Institution. The IFI approves the order, agrees to buy the goods from the seller, and grants to the seller wakala so that it sends the goods in the name of the Islamic Finance Institution. Seller sends the goods as well as the invoice and advises the buyer that the payment must be made to the IFI. IFI pays cash amount of the goods to the seller. The buyer pays to the IFI on the due date of the receivable. This was the murabba-based factoring. There are different countries that factoring is based also on commodity murabba. For example, in Dubai it is commodity murabba. And bayad-dain, we sometimes see in Malaysia, bayad-dain based purchase of debts based factoring, Islamic factoring. As to the Islamic international factoring, that is our subject, there are four parties: the seller, the buyer, the export factor, and the import factor. Both or one of the factors is an IFI here. In this case, after the seller sends the goods to the buyer, the export factor assigns its receivable by way of wakala to the import factor. And the import factor collects the receivable against the commission, also granting protection against bad debts. So guaranteeing the payment. As you see,
you still have 2 minutes. Yeah?
In both cases, the factors approve the order. Factor is the sole owner of the receivable, and the factor pays to the seller on an agreed date. After having seen these similarities, a working group was established from different Islamic countries, and with the coordination of FCI, we have prepared the supplemental agreement for Islamic international factoring. And this agreement was approved by the relevant Sharia boards in Dubai and in Saudi Arabia, the legal committee of FCI, and the council of FCI in 2018. There was only a few modifications needed in the international factoring rules. Agreement of the parties for the permitted goods and services, because you cannot sell everything in Islamic under Islamic rules. Changing the word interest to late payment amount for delayed payments, and to get rid of the riba, and the fact that the factor must be the owner of the receivable. FCI has new Islamic members now, and the Islamic international factoring transactions will start very soon. We have just made some other changes in some other rules. Now, I want to talk about the business potential of Islamic international factoring briefly. Islamic population is about 2 billion people. It's about 25% of the whole world. Islamic financial assets are expected to be about 4 trillion US dollars.
You still have 1 minute. You still have 1 minute.
Yes, it is going to be finished. In accordance with my research based on World Bank figures, 57 OIC countries have a trade volume of 2.5 trillion US dollars in 2016, and about 80% of the volume is with these first 20 countries that you see. Most of them are non-Islamic countries. We can conclude that there is a very high potential volume for Islamic international factoring, as you don't have to deal with Islamic companies and countries only. This chart shows the percentage of various Islamic finance products that affects the total volume. For the time being, factoring doesn't exist in the list. With this potential growth, it will not be a surprise if we see Islamic factoring somewhere in the middle in a few years. So therefore, please take advantage of this new horizon also in Africa. Thank you very much.
Thank you very much.